Hey everyone, welcome to the Tim Pearson Team Market Update video where we help you understand what's happening in the DC Metro real estate market so that you can make wise real estate decisions and get further faster in life. Let's take a look at the latest numbers.
I want to start by looking at an interesting stat where it was reported that throughout the U.S., prices appreciated about 19% from Q2 in 2020 to Q2 in 2021. And this is an astounding number for 12 months. And it's probably something that you've heard about in the news. Now, when we look at this across the country, we see it reported about 15 to 16% in DC, and some areas in the West over 20%. And this makes sense as people fled the cities during the pandemic looking for more space, and most of those areas, besides California, have more affordable housing, so it's easier for those percentages to be higher. When we look at what the experts predict for the future, we're seeing more modest numbers. 11% for this year, and then back to 3 to 5% over the next 5 years. Now, some might look at that and be a little discouraged, but think of it this way. If we see an average of 5.7% appreciation through 2025, then a homeowner would be up about 31.8% in 2025 if they bought this year. And when you consider that most people aren't buying all cash, their return on their investment is astounding. If you put 20% down on $500,000, that's $100,000, but you're getting the 5.7% return on the full $500K, not the initial $100K deposit. So if these numbers hold up percentage-wise, you would have made $159,000 on your initial $100K down payment in 5 years, creating an over 150% return. And that type of investment is what we love to see for our clients and why we are in this business.
But there are some threats to the real estate market right now, and the biggest one that we are seeing is rising interest rates that could possibly cause prices to come down or flatten, even with that solid buyer demand that we have in place. But a small drop or flattening is still a big difference than the pullback that we saw during the Great Recession, which was driven by a loosening of requirements for buyers to get loans. And we have to expect that some softening will happen. Interest rates are historically low right now, and some argue that they are contributing factors to the inflation that we're experiencing. Now, interest rates have begun to rise a little bit, but they're right around 3%, which is very good, and they're still well below the historic 6% average that you see over the past 70 years. Experts are predicting that they will rise as we move into the next few years, but most don't predict that they will jump up significantly in a very quick manner. These rising interest rates will cause your mortgage payment to rise, along with decreasing housing affordability. Some think that it's going to cause prices to go down, and that is possible, but it will also increase your monthly payment, so I wouldn't expect that you're going to see significant savings in your monthly payment either way. So, we still believe that buying a home remains a good investment, and now is an ideal time to lock in a great mortgage rate for a home that you plan to own for the foreseeable future. If you're thinking of buying, you also may be interested to know that the average FICO score is around 740 to get a conventional mortgage. However, there's still options for you if your score is lower. We work with some great lenders that can help repair your credit score and show you options to buy a home if you have a less than perfect score currently. In relation to that, most first-time buyers ask us, what can they afford? Here you'll see that lenders want to see that you have no more than 35 to 41% of your monthly income servicing debt. So if you have no loans right now, the lenders will approve you for a mortgage of up to 35 to 41% of your monthly income. Now, we don't recommend that you go that high in most circumstances, and if you have current debt, then you need to factor that in. All that said, we are happy to discuss these things with you on an individual basis and connect you with trustworthy people to ensure that we create the best plan for your circumstances.
Turning to the local real estate market, we're seeing signs of cooling. While modest, you can see an increase in the number of active listings on the market over the past few months. You might be asking, well, are people not buying homes? On this chart of homes sold, you can see quite the contrary. More homes are selling than ever before. So what's the cause of the cooling? We believe it's because we're seeing an increase of new listings on the market. And there's been a pop in this new inventory in the second half of this year that is helping meet buyer demand and relieving some of the pressure caused by the lack of supply. We believe that this inventory would have come on the market last year under normal circumstances, but was delayed because many homeowners put major moving decisions on pause during the pandemic. The good news for homeowners is that during the pandemic, we saw the demand for housing explode and the supply dwindle, causing the market to become red hot and prices to escalate quickly. However, now we're seeing a slight pullback from peak pricing over the past month.
I want to finish with two final thoughts. One is that the market will have fluctuations, but I truly believe that the fundamentals of the housing market here are very strong. And we have seen tremendous appreciation over the past year due to low interest rates and strong demand. However, this is real demand from very well qualified buyers. It's not like the run up to 2005 that was caused by speculation. As you can see in this chart, from 2004 to 2006, crazy financing was available. You could get 106% of the sales price in your loan if you could fog a mirror. You didn't even have to show documentation to prove income. They just trusted what you said. Now today, it's much more intense. They look at everything. And these loose rules from back then allowed people to buy homes, causing prices to rise that really shouldn't have. And that increase in demand created a run on housing as people saw prices going up, and they looked at housing as a speculative investment. So they bought another house to rent or flip. And in some cases, they bought 5 houses, which caused an increase in demand, which further pushed prices higher. But it was all artificial demand because of the ease of which you could get loans. It was not built on sound fundamentals of supply and demand. And since 2009, the Great Recession, buyers have had to be well qualified for a home, and investors have had to put much larger down payments, weeding out a lot of the riffraff, which has returned the markets to a more stable supply and demand foundation. The bottom line for us is that home ownership remains one of the fundamental keys to accumulating wealth in America. Not only does it provide a roof over your head and secure place to live, but because mortgage payments generally remain fixed while rents may rise over time, a home can also be an attractive hedge against inflation. Together, these features can give homeowners an enormous advantage over renters when it comes to accumulating wealth, which gives people more options to invest their time and energy where they want. And that's what we want to do. It's not about selling you a home. It's about putting you into a home that allows you to have more margin in life so you can invest in your family, community, churches, hobbies, whatever it is that you value. And we love to walk alongside you in that pursuit. So if you have any real estate needs, buying, selling, investing, building, call us today and let's talk. We are here for you whenever you need us. But know that now is a great time to do something before the interest rates rise. That's it for this month. Hey, do me a favor and share this with someone you know that might need real estate advice. We would love to help the people you care about, and remember, we are never too busy for any of your referrals. Have a great month, and God bless.